This is The Blockchain Show. The Blockchain Show is a weekly podcast that demystifies and promotes widespread adoption of cryptocurrencies and distributed ledger technology.
This week on the show, Ethan and Steve talk to Simon Dixon from Bank to the Future.
I'm Steve. I'm a co-host of the Blockchain Show, and really excited to have our guest on today. Simon, you want to introduce yourself?
Sure. Yeah, I'm Simon Dixon. I'm the co-founder. Well, I'm known as the co-founder of an online investment platform called BnkToTheFuture.com. But before I started that, I wrote a book called Bank to the Future. And before Bitcoin and all this fintech stuff, I was working in investment banking. And I left in 2006 to write a book on systemic risk in banking. So I came from the banking side and got into Bitcoin later.
Did you have like a crisis of consciousness in the IB side or not?
I wouldn't really say that, because when I left, there was no problems. We were at the peak of an incredible bull market. But I started returning to, before I worked in banking when I was a student, I did economics, and I always was dissatisfied with economic theories that we were using to run our economy. I really started looking more in depth into money and decided that I wanted to leave the banking sector and work on a business, and then wrote my book Bank to the Future, which was all about the future of finance, systemic risk in banking. And because the crisis happened shortly after, that kind of was the birth of my career in alternative finance.
What's the main driving force behind Bank to the Future, the book?
Well, Bank to the Future, it's had a few drafts. The first draft was before Bitcoin existed, before fintech was a word. And it was really focused on top-down reforms that the governments are going to need to make in order to drive sustainability in the banking sector, and some forecasts on what would be the driver of its collapse. But then I did a few drafts later because I was invited to the first Bitcoin conference in the world after writing the book, and spoke on the subject. The drafts after that talked about some bottom-up reforms where entrepreneurs in fintech and open source projects like Bitcoin could actually drive the reform and force the reform that the governments will need to make at the destruction and harm of a lot of people, unfortunately. So I wanted to let people know so they could start preparing their finances around what I thought the future was actually going to look like, because the top-down reforms weren't happening at the government level. So the bottom-up reforms were happening at the entrepreneur level. And therefore, that's going to drive some serious change and unfortunately hurt a lot of people in the process. But that's where we are.
Is that like a common misconception that change happens a lot of times from top down? At least that's what we think happens, but it turns out in reality, in order for real change to happen, it's really a bottom-up movement.
I'm not much of a politician. I'm just a finance geek that really looks into banking and has specialized in this subject, and was completely intrigued by the entrepreneur spirit that actually emerged after the financial crisis. And then some of the, I guess you could call them anarchy movements that came. That actually led to technologies like Bitcoin creating just such a tremendous force that we're actually seeing roll out on a very small scale. But the more and more I'm involved in this sector, the more and more I'm convinced that we're actually at the beginning of something really special, and one of the most exciting times to be around finance in history.
Yeah, blockchain is definitely going to, really change the way finance is going, or the future of finance. You said that you were at the first Bitcoin meeting. Well, who was involved in the first Bitcoin meeting, and what was that like?
So I flew over to Prague, and it was organized by one of the early developers that were involved in Bitcoin, and a very outspoken, controversial character called Amir Taki. And when he arrived, it was, I'd say there was about, I can't quite remember how many people, maybe 30 people in the room. And there was a startup. It was sponsored by Mt. Gox, I believe.
Okay.
And there was a startup pitching, a guy called Tony Galippi, who was pitching his concept for BitPay. That was where I first met Max Kaiser, who was one of the first one of the first TV mainstream channels to cover Bitcoin. And the room was probably, I'd say, filled with about half activists and most of them coders and developers. I think I've got to refresh my memory, but I think this was when the price, had a massive run up and then crashed down from like $20 to $3 at the time. It was a really, and there was some traditional, and I was there giving the thoughts on Bank to the Future. And then actually this is when I first really started looking into how Bitcoin actually counters some of those problems that I was talking about in the first draft of the book.
Well, what are some of the problems of the financial system that Bitcoin tackles?
So the main takeaway, and it's not necessarily that Bitcoin tackles them, is it just created a counter movement that does the opposite. But the three, if we could sum the book up into three takeaways, I was showing how these three forces in the traditional banking system will be what leads to its destruction in the end. The first was that when you deposit your money with the bank becomes the legal owner of your money. So legally, as soon as you receive your wages into a bank, that money is no longer yours. The bank just promises to repay it. And therefore, they need things like deposit insurance so that you can guarantee a certain amount of money as long as the government is solvent and the insurance plan is solvent, is yours. But it also introduces non-neutral, the non-neutrality of money, where it's not yours. It's just promised to be repaid for you. But if they don't like how you're spending it or what you're doing with it, and the knock-on effect that I talked about is that when it's no longer yours, at times of systemic risk, when banks are in financial, in insolvency situations, they can exercise their entitlement to your deposits because they're not yours, and that's exactly what we saw in Cyprus. So that was the first force. The second risk in the banking system that makes deposits more risky than most people believe is that when you deposit your money at a bank, not only do they become the legal owner, but they spend it as they wish. And so I spent a lot of time looking at bank balance sheets and found that approximately, when you take an economy like the UK, which was the one that I focused on at the time, about 40% of the banks, the way they're spending your money is to drive up the prices of property and make property speculation the main asset class. The other 40% of the deposits were being used on financial speculation, and only a small amount of it was being used for actual lending in consumer loans and what most people think banks do. Whereas if you look at those two forces, and then I'll do the final one, Bitcoin did the opposite. So the first thing it did is it created a bearer asset similar to cash, where you own your own money, and whoever owns that private key is the person that owns the money. And so it was a bearer asset that had no counterparty risk, where you fully own. So much like if you hold physical gold, cash, art, wine, Bitcoin became another bearer asset which you could own. At the time, it didn't have much value and there was not much use for it. But we were discussing that it was actually an asset like that. On the second force, it's also got a peer-to-peer payment system attached to it. That the more people are mining Bitcoin, the more secure the payment actually becomes. Now we've reached this phase where we've created one of the most secure ways of transferring value from A to B anywhere in the world, with no counterparty risk and neutral money that no one can intercept. apart from trying to gain access to your private key, which is the ownership right of it.
Is there another way to do that? You said the most secure way. I don't mean to interrupt, but is there any other way, or?
Well, I mean, in terms of transferring online over, globally,
Yeah.
there's I don't know of any other asset class where you can own it and you can transport it from A to B without any kind of interception. And as we speak, Bitcoin is the only asset class that can do that.
Okay.
And then the final force was the monetary policy. So, banks, not only do they become the legal owners of your money, not only do they spend it as they wish, but they also get to create money because economics, and this is where I got back into the economics in the beginning, has ignored money creation in much of their economic models because they model a bank as an intermediary between borrower and lender, which is not the case. When banks invented, in fact, banks were the inventors of digital currencies. When they took their balance sheets and made people's their ledgers digital through people logging into their online banking and creating digital ledgers, they actually invented a digital currency, which was a digital representation of the government's currency, and they had full rights over its creation. The driving force behind how much money a bank creates was their appetite for risk and how much they wanted to lend, because rather than a deposit, if you look at a peer-to-peer system, a deposit has to exist before it can be lent. In the banking system, a loan exists and then it creates a deposit, and therefore they became the creators of the money supply. And this has all sorts of knock-on effects when the government have outsourced the ability to create their digital fiat to a private banking sector and based it on debt. It means that you introduce real systemic risk into the monetary system. And Bitcoin did the opposite. It created an asset class that has a fixed supply where the release of the money is based upon mass and code. And because Bitcoin, in the early days, it could have been a Ponzi scheme. It could have relied upon new investors coming in. But because it attached a payment system to it, and that payment system produced a user case called neutral money, it therefore started to actually create a monetary policy very similar to a fixed supply commodity. And so that's what first got me interested in Bitcoin, because it created, I discussed those three forces and the solutions to them. And then Bitcoin created an alternative economy, which did the opposite of those three things. So that was really interesting to me. I never thought it would come this far, but it did.
Yeah, such an interesting experiment that Satoshi created and has been working for the past 7 years. The way money is created, at least in America, is just so strange to me that when you go into a bank and you get a loan, I mean, Bitcoin didn't invent digital currency, and people talk about, sometimes saying, like Bitcoin is a digital currency. Well, the dollar is a digital currency. 80% of all dollars are digital. There's such a small amount of dollars that are actually physical green, M1, I think is what it's called. Mm-hmm. And so when you go into a bank and you get a loan, the bank now has, 10% of that is all they keep in actual cash reserve or that they actually have on their balance book. And the rest is just created out of thin air.
That's actually a very common myth as well. People think that fractional reserve banking exists, where they actually keep 10% on reserves and lend out 90%, and then it gets recycled. That model completely broke many, many years ago. Now there is no reserves.
No.
And you just simply lend based upon a bank finding a market that they think is creditworthy, that isn't going to explode the money supply. And so what happened in 2007, you had some banks that were leveraged, investment banks that were leveraged 365 to 1, but the investment bank's business started to intersect with the retail bank's business. and therefore investment banking was being used as a way to loophole many of the regulatory reserve requirements that don't actually exist. So in the end net effect is, if you think fractional reserve banking is a Ponzi scheme or a scam, it's actually a lot worse because the reserves aren't there either.
Scary to think about.
Yep.
So how is Bitcoin and blockchain going to fix this?
I don't necessarily think Bitcoin and blockchain is going to fix it, but if you're asking me to do some more crystal balling on where I think this is going, we've now found genuine utility for Bitcoin, which is that Bitcoin, I believe. So when I started investing in the sector, one of the first investments we made was in BitPay, and we've invested in about I think we're on about 45 to 50 odd companies since then in this sector. I had an investment thesis which was the opposite of what the venture capitalists did. I believed that Bitcoin had the first two user cases would be the underserved, and the underserved could be split into two sectors, which is those that can't get merchant processing, which was the first user case of Bitcoin, which was the illegal activities. And also the underserved in that those who don't have access to banking, or their traditional domestic banking didn't give them access to global financial services. And I believe that Bitcoin could bring a lot of people in, and that was an original theory. So we started investing in some of the liquidity providers and exchanges. We invested in BitPayzer in Africa, Unicorn in India, BitSpark in Indonesia and Philippines, Bitso in Mexico, all the people that could drive bringing more people into global financial services. The second thing I thought it would do would be a hedge against economic uncertainty and bank deposits, systemic risk in bank deposits. And so I believe that was going to be an asset class for the ultra rich as well. So we had the two parallels. We had the ultra rich that were going to start hedging into gold, art, wine, and Bitcoin. And at the other side of that, we had genuine utility and financial services for those in the financial inclusion. Now, the middle market is where all the venture capitalists started investing, i.e. BitPay. We invested as well, but merchant processing for people in America, businesses in America, and various other countries that are fairly advanced, that have good banking systems, and so a lot of the venture capitalists were put off with the slow growth of Bitcoin, because I believe that they were investing in the sectors where it didn't have the biggest impact. So then really, really interesting things happened after that. And that was that the venture capitalists who had all invested in the Bitcoin businesses started speaking to some of their other investments and started trying to push the market and see if it could integrate with banking. And so a lot of the VCs would then arrange conversations between their investments and a lot of the banks and financial institutions. And then suddenly, out of nowhere, a couple of the banks actually went public saying that they're investigating this technology. And what they did is because of Bitcoin's background in serving some of the markets that banks and compliance don't want to be involved in, they created a new word for Bitcoin called blockchain. And this blockchain word was just a compliant way of saying Bitcoin, in my opinion, because I still believe there's only one blockchain that works. There's only one blockchain that can be relied upon.
Not to interrupt, but blockchain was in the Satoshi white paper. It was actually two words.
Sure.
Whatever.
But they popularized it because they didn't want to use the word Bitcoin. Because of the publicity that happened prior to that and some of the events with Mt. Gox and lots of challenges Bitcoin had along the way in becoming what it is today. And so this whole blockchain thing then created a wave of the largest companies in the world all investigating how they could do or what they could do with blockchains. And my belief is that there's not much they can do, because the original invention of the blockchain, Bitcoin, was a way of eliminating counterparties. And in order to eliminate counterparties, you create this proof of work mechanism where people are mining and verifying everything. And that's decentralized all around the world and controlled by nobody. and you need a bearer asset in order to incentivize people to perform that proof of work where they're verifying all the transactions. That model does not fit into many centrally controlled companies that think that they can get utility from blockchain, but actually they will introduce massive risks into their models, which is they'll need a bearer asset that can be hacked, and that's a problem. Especially when you introduce it into a company or that type of structure. So we had this massive distraction around blockchain that I believe the end result is that many of the proof of concepts and all the consulting industries and everything that's been created around that will just introduce ginormous risk that at a very small benefit to a lot of the companies. And so then it comes full circle back around to Bitcoin at that point, because what Bitcoin has created is the ability for you to own your own assets, to transfer it from A to B, and to have a monetary policy that means that it encourages savings and is a deflationary currency and a commodity and a stock and a technology and a protocol, which is why it's challenging for all these tax advisors and regulators to figure out how to utilize it or what it is. And then the final part of the story is the central banks then all came along and started saying, well, we're going to create our own digital currencies. And so now the big buzzword right now, every week, if you read the announcements, is a new central bank saying they're creating a new digital currencies. So my forecast on this is as follows, and then is that actually they don't need blockchains to create digital currencies. If they do, they're going to lose a lot of their income, which is their seigniorage income. They're not going to give that to miners. They're going to want it to recapitalize their balance sheet, because every central bank right now, apart from the IMF, is insolvent. And so they need to recapitalize. At the same time, they're driving a war on cash, like we're seeing in India at the moment. And so what they want to do is create a digital version of the fiat currency and issue it. And we've got about 6 of those right now from central banks. You can use them as we speak. Those digital currencies are backed by the currency that works domestically. But the problem is that the next step of that is their war on cash, so that they want to track everything. They want to automate tax collection, and then they want to switch off your currency if they feel you're not doing what they want you to do. So I believe the end result is all of this is good for Bitcoin, because I believe that people, as the whole ecosystem evolves, they'll realize that actually the only way to avoid and circumvent this systemic risk that we're having in banking is to actually hold a currency that works without the systemic risk. And while Bitcoin has its own challenges in volatility and having to secure your own private keys, I believe that cost will be worth it as we see more and more challenges with traditional currencies. But I believe it will be integrated direct into central banks. So like one of the companies we invested in, Bitso, they've got a direct integration between their Bitcoin exchange and the Mexican central bank. When central banks are issuing their own digital currencies, they are doing that because I can only think of a couple of reasons. One, systemic risk in banking. They need a way to protect against that, so that next time when a bank goes bust, they don't need to bail out. They can let them go bust. And they can replace depositors' money with central bank money. And also part of their war on cash, because they want to track and trace everything. But their money will be a worse form of money for store of value. However, it will be a better form of money for spending in the local economy. So I believe in the future, wealthy people will hold a lot of some of their wealth in Bitcoin. It will be interchangeable with traditional fiat currencies. The government have now, by central banks issuing their own digital currency, reformed banking exactly as I was, kind of saying in the original book. But inadvertently, it's all happened through entrepreneurship and technology innovation now, and not through government policy or politics. And so it's really, really interesting times. It will be interchangeable, and you can spend your local currency issued from a central bank, but it's not backed by debt. And the systemic, and you essentially, central banks are now waging war on retail banks, and it's all because of this experiment, I believe.
You had mentioned a few times that these governments are creating digital currencies. Did you mean like cryptographic currencies, or did you just mean, because we had mentioned earlier that most cash is digital already. It's not like
Hmm.
it's been digital since the 70s. Did you mean that there's governments that are building their own cryptographic currency, or?
No, I believe so. We just got to get through a bit of the jargon. So if you're
Yeah.
saying cryptocurrency means blockchain, then they're not doing that.
No.
They're
Okay.
experimenting with that, but there's nothing for a government to gain from that whatsoever. They're giving away their seniorage income. It's just something that I don't believe is ever going to happen, even though some of them are experimenting with it right now. What they are doing is they're creating their own digital currency issued by the central bank rather than by the private bank, which means it's not backed by debt. So it means that money is created directly, much like they created quantitative easing as a way of injecting money into large corporations that they hoped were going to employ more people, but instead they bought back their stock and created a stock market bubble and a bond market bubble. And didn't have any bottom line impact as wages continued to decrease, and people started to get poorer, and more of their money was being used on repaying debt. What they could do is they could directly allow people to exchange their bank deposits for central bank reserves, and then you've created a debt-free currency. But you create a new set of challenge, which is that you need to trust a central bank. I think I prefer having my money at a private bank than a central bank. In terms of trust there.
What do you mean by a private bank?
So at the moment, if you have money in a bank, if you have a positive balance on your online banking, it means that somebody else is matched with debt at the moment. If you store your money at a bank, that is the money that was created by the private bank. Otherwise, you wouldn't have a positive balance. At the moment, you can exchange that for cash by withdrawing at an ATM. But
left.
if they let you, and countries like Greece have said no more, and that's all because they have legal entitlement to your money. It's not your money if it's held at a bank. You've given the private key to Mt. Gox if you hold your money at a bank, but it's something we all do because we have to pay our taxes. We have to get paid in certain ways, and this is where the system has evolved. But when we start seeing policies where banks are able to go bust, people will start losing, some of that trust there. When we start seeing wars on cash, people in India, I'm amazed that we haven't seen, absolute rioting from the people in India. Maybe there's something we're not seeing. But as part of the war on cash, it's all of this, I believe, is driving the continual increase in interest in investors that are looking at Bitcoin.
Yeah, I think sometimes the technology's time has come, and societies to may have to have a government manage money, or there may not be a different way in the past to have done it, and then a technology comes along, and you have the internet, and you have Bitcoin, peer-to-peer digital cash, and there's just no stopping it. Its time is here, its time has come, and we watch, unfortunately, places like Cyprus go bankrupt, and Argentina, Venezuela. There are a number of there's just the ruble can't keep up. There's just I'm in America, and the United States petrodollar does pretty well. Are you in England or the UK?
I'm in Hong Kong.
Hong Kong. Okay. So there are, my particular currency isn't really that bad comparatively to a lot of other currency. It still has the same problems that fiat currency has. There's nothing backing it. It's just declared by the government this has value because it accepts it's basically gets value because you can pay your taxes with it. I don't know where I was going with my point.
Yeah. Well, but let me be clear. I believe that fiat has a very important role in the world. And that is that you will spend domestically using fiat currencies. And that behavior, I don't think is going to change, whether the central bank issues it, whether the private bank issues it, whether it's cash. That behavior is not going to change. What I do think is going to change is the ability in the international markets to use Bitcoin as a way of attaching, domestic currencies to global financial markets, and also the way in which wealthy people store their finances and money. And that creates incredible challenges for governments, because all of these are based upon global markets, whereas taxation and government policies and regulations are all about domestic markets. And this is just a classic once in a lifetime what should I say, era that we're in, where the world is going global in terms of their thinking. Many people ask me, what can Hong Kong do to encourage the blockchain? And I say the reason that blockchain and Bitcoin, and there's some large exchanges and companies here, is because they're doing the exact right thing, which is step out of the way. Because I don't think in terms of jurisdiction. I don't think in terms of that. The only reason I have to think like that is for tax and regulations only, not in how I actually use things. And how governments are going to catch up to that trend, because they do not know, how to handle that economy. And I can't even think of the answers to that, because it's such a complex challenge. That we're alive in this time when that model is changing. And I just want to say one thing. I really don't want the destruction of banking and fiat currencies. That will not be a pretty thing to happen. That will hurt a lot of people, and the world will not be a nice place to live in, just so that we can earn some more money through our Bitcoin. But I think you're going to have an interoperable economy where the role of fiat currencies becomes less significant, but it still serves that purpose as a stable currency for spending domestically in your economy. And Bitcoin has an impact in the global interoperability. I can't even say that. How these different currencies and institutions interact with each other.
How would you do loans in an inflationary currency? In a deflationary currency. So if I take out a loan for 10 Bitcoin, and it's worth like, $1,000 USD or something. Never mind my question. Sorry about that. I'm looking at
No, I do think you're touching upon an interesting point in that. So when you're in your domestic country, the reason that volatility is not an important factor and inflation is very hidden and hard to see. But they feel it, definitely in the property markets, and that's because banks direct all money to property markets. But the reason that volatility with Bitcoin is a bigger issue than with any other currency is, firstly, it is volatile because it's less liquid. But secondly, we've got massive volatility in all currencies, many currencies at the moment. But you never feel it until you start doing stuff in the international markets, and not everybody does stuff in the international market. And so most people just stay domestically in their own currency, and therefore volatility is never a thing that factors into their thinking. With Bitcoin, because it's owned by no jurisdiction, you have to deal with all the challenges that you deal with international markets. So if I take a mortgage in Cyprus and I'm paying it in pounds or dollars, then you assume all these risks, and financial products are created in order to hedge those risks. So the challenge with Bitcoin is that it brings those challenges that people are facing in international financial markets, and products have been invented to solve those problems. It brings that to everybody, and most people have never had to deal with or think about those things in their life. But unfortunately, the way the economy has evolved now is everybody has become a financial speculator and trader just to make ends meet. And if they're not becoming a speculator and a trader, they're probably getting screwed by the system, and their disposable wealth is going down and down and down. And unfortunately, the way that the markets have evolved is we're all driven to actually have to become financial experts just to keep afloat, and that's a real challenging place to be. This is what kind of got me into investing in this sector and Bitcoin and some of the things that I think about. So when I started investing in the sector, and more and more people started coming to me and saying, what are these things? And I was saying, look, I don't know what companies are going to succeed. I don't know what the future looks like. I've written a book on the subject. I believe that these are my crystal balls, but anything can actually happen. But one thing I do believe is that the future of finance looks very different from the past. And I believe that fintech companies are going to have a much, much bigger impact and play in the world. And there's this destructive forces that are coming along. And so I didn't know which companies were going to succeed, so I wanted to invest in them all. And so that's kind of why we created Bank to the Future platform, so that I could diversify across the whole sector and co-invest with other people that believed that this future of finance was going to look very different, that there was a multi-trillion-dollar market that was going to be disrupted, and be able to diversify and have a wide pool of all the different investments in this sector. And that's kind of where Bank to the Future launched. The platform, BnkToTheFuture.com.
Yeah, Back to the Future is pretty cool. For our listeners who don't know about it, it's a place for a accredited investor, and in the States, as most of our listeners are in the States, an accredited investor is a person who's single who makes over $200,000 a year, or a married couple that makes over $300,000 a year. I believe those are the numbers. Or if you are, I don't know, if you have some sort of cash reserves, you'll know it if you are one. But so Bank to the Future works only with accredited investors worldwide to fund blockchain companies, or tell me about that.
Yeah, so we're a fintech online investment platform, and we, as far as I'm aware, I believe we have the largest community of fintech investors, all investing online in the future of finance. We focus on accredited investors because this is such a high risk asset class that we only want to deal with people that can afford to take the risk, can afford to diversify, can afford to do what is required to manage a sensible portfolio in this sector of huge high risk, potentially high returns, where you need to diversify widely. And part of that is that one. And then secondly, it's due to regulation. So we spent approximately 4 years getting the regulations right for this, to be able to deliver the platform and the right, in the right model and the right permissions, and be registered in the right jurisdictions and everything we needed to do. So
sounds like a nightmare.
It was a 4-year challenge, and then we launched about a year and a half ago, and we've now had about $120 million invested in the sector. So if you believe the reports, I think the reports say there's about $1 billion that's been invested in this sector. It seems like we're responsible for about 12% of that.
And you only do Bitcoin companies, or do you diversify across any other blockchain?
We have no intention of going beyond our fintech niche, because it's all about the future of finance. And fintech is going in many different directions now, and the technology behind some of these, this stuff is being used in other sectors and other verticals. So we try to stick with our, we've gone outside of our niche slightly with things like, we did Kim.com's Mega Upload 2. We did MadeSafe, which are looking to build, use some of the same encrypted technologies for different user cases. We did Storage, which is looking to do blockchain file storage. So we have deviated slightly outside, but these are the areas where, we're a team of people that understand this sector. We definitely can't forecast which companies are going to fail and succeed. That's up to our investors. But we know the sector, and we're looking to stay niche to that sector. It just so happens that we've done a lot of the Bitcoin companies that you may have heard of.
What's Kim.com like? What was that deal like?
That was a very challenging deal, because in order to put that together and to do that in a way, So this a hugely risky deal because of Kim's ongoing legal challenges. But our legal counsel had to mix with their legal counsel, and we found a way for those that were willing to take such a huge risk to build something that the investors were very passionate about seeing, and make sure all the correct disclosures were there. But Kim's he's a trooper, he's a fighter, and he's really excited about bringing new technology now that he believes the environment has changed since he was being first targeted.
Looks like you're doing the accredited side of Airbits. They also have a non-accredited investor in the States. If you wanted to go to WeFunder, do you do a lot of partnerships like that where these companies have multiple sources of funding and you kind of handle the regulatory framework for that particular side of it?
Yeah, so because we've got the largest community of fintech investors that are investing online, when a company lists on our platform, they get a lot of customers, a lot of exposure, and generally, because we're niche, they get the exact type of investor that they're actually looking for. So sometimes someone comes to us like Airbits, and they want to do. They want to take advantage of some of the new regulations that are allowing non-accredited investors to invest. And we don't necessarily want to deal with non-accredited investors for a few reasons. Firstly, there's no global model. It's jurisdiction by jurisdiction once you're doing non-accredited investors. And therefore, there's also the companies have to do a lot more reporting requirements. Also, taking on a lot of investors to your company can sometimes be very destructive to your company. So when a company raises finance through us, they get one investor, and then we pull together and syndicate the other investors that invest through us, because negotiating term sheets and scaling the company with a lot of investors is very challenging and can sometimes prohibit the growth. We've also found that when you allow someone to invest a small sum of money, some people can invest for disingenuous reasons. They might be a competitor or a troll that just wants to cause as much destruction. And if they can get in for $10, then that's a good way of getting access to the information. So we found that the platforms that allow very small investments often have the most challenging customer service problems. The most challenging investors that sometimes are not doing it for the right reason, and also they're the same people, the very first people, because they may have been investing above the money meant a lot more to them. So they're the first ones to go and complain and try and all these things that can cause problems. So after studying the market a lot, and we were involved in the first regulations in the UK to bring what became known as equity crowdfunding to market, that was later used by the US, we determined that this asset class isn't necessarily the greatest asset class for certain people to invest in, and so we stuck to that market so that we could achieve the global vision. And provide more liquidity into the market, while the venture capitalist and traditional market tries to figure out what's happening with this blockchain Bitcoin thing.
Yeah, these are kind of like extreme binary bets, huh? Where you're going to lose it all or make 100-time returns, or
I wouldn't like to say that. Well, I try and stay away from forecasts of returns because there's always the extreme markets. That this is high risk, high return investing. If the company goes bust, you lose all your money. If this sector grows, then likelihood is that a few of these companies are going to be very large. If the whole Bitcoin blockchain fintech sector becomes really significant, and the investor's job is to be diversified, where the ones that succeed can make up for the ones that lose. And this is not your mortgage money. This is not liking to your savings products or anything like that. is the high risk, high return part of your portfolio.
So let's talk about like Amazon for a second. Everybody knows Amazon. They think, Amazon is making money by selling products online. And that's not where Amazon is making money. They're probably losing money on that right now because everything just goes into R&D, building out other stuff. It may be profitable in the future, but where they make their money is on the Amazon Web Services, which not everybody knows about. People that are investing in the stock probably do. Is there a fintech company that's going to be like that you see in the market that is kind of building the framework or kind of building the architecture or the infrastructure of Bitcoin that's really going to be that may be known for being a wallet or a on ramp, but really has good solid architecture building skills that you're working.
That is the $1 million question, and I'd shy away from giving specific companies that I think might perform well because I know that people would take that as advice, even if it's not advice. So I try and stay away from things like that because, but in using your analogy of what you said about Amazon, interestingly, and this is why I'm pretty excited about a company we invested in called Storage. And they've created what I believe will be a genuine user case of the blockchain, and that is allowing people to store files cheaper, faster, more securely. And they believe they can undercut the prices that Amazon is charging because they're storing it on centralized servers. And I'm really interested in where that project can actually go because it's a very easy user case for people to understand. And they're building technology that allows developers like Kim.com Mega Upload 2, who's trying to do something that might compete with Dropbox or, but with privacy in mind, to actually, rather than use Amazon S3, they could use the storage layer. And I really am cheerleading for that to succeed because I think there's a lot of potential in that.
Yeah, I guess Heroku, which is a competitor, probably I think maybe the third most popular, cloud infrastructure. I think does it go Amazon, Google, Heroku, or?
Not. I wouldn't want to give the quotes, but something like that. Heroku's a really popular one in like the startup earlier stage. Yeah.
And so right now you can spin up a Heroku server and you get the option right there of using storage to be redundant.
Yeah.
And so that's really cool to see a company, in the blockchain space kind of interface with, a company that Heroku has absolutely nothing to do with the blockchain right now that I know of.
Yeah. But again, my belief of the most important role right now is by the very same company, the companies that most Bitcoiners hate, which is the exchanges. They are the profitable companies. They are the ones that's providing the infrastructure by which all the other companies can build on top of, and liquidity in the exchanges for every market is something that's still not fully there, but it is where I think, and then providing the leverage products where people can create hedging products and speculative products, using derivatives markets. And remember, banking created a lot of very, very interesting, useful products. The challenge is that the foundation of money was built upon a debt-created private banking sector. With Bitcoin, I see a monetary policy that has its own challenges because the price is probably going to go up over time with lots of volatility in between, which creates its own challenges and encourages people to save, God forbid, which is not what the government wants. But you can use that foundation to build a lot of the same products that investment banking created and rolled out so well, but without the debt-based system underneath it that creates the systemic risk based upon those three things that I talked about when we first started this call.
Interesting. So you have no confidence in, or not, I don't know, but confidence. What would you say about something like MakerDAI or the MakerDAO. Are you familiar with their product at all, or no?
No.
No. Okay.
So is this another version of the DAO? Is this?
It was like, a DAO is just a term, decentralized, or wait, decentralized autonomous
organization.
and a lot of the times these DAOs weren't actually decentralized or autonomous, or it was just kind of like a buzzword. Like the blockchain is used a lot as a buzzword. Nobody really knows what a DAO will look like because it's only been in science fiction writing up until this point. Mm-hmm. But so MakerDAO is a decentralized autonomous organization that allows and I don't have a finance background, but allows people to purchase Maker DAIs, which are a counter token that I don't really understand the system. I can't really explain it that well.
So I'd say a couple of things. Firstly, in my opinion, there's only one DAO that's worked that I know of, and that's Bitcoin. It's the only decentralized, autonomous, whatever you want to call it, thing that's actually worked, and that's because Satoshi Nakamoto remained anonymous, and they were building the blockchain and Bitcoin and the mining power and the proof of work at a time when nobody cared, and because nobody cared about it. It wasn't such a huge incentive to be hacked and attacked. And all new blockchains, because the world is more, au fait, and they understand a bit more about blockchains, any new ones that launch, they don't have the same advantage that Bitcoin had, where they could figure out how to become sustainable and build out a lot of the architecture in a time when nobody cared. And that's why Bitcoin is where it is. And the second thing of why Bitcoin is where it is because all of the events that led to Bitcoin becoming so scandalous, the Mt. Gox scandals, the Silk Roads, everything that led up, the pump and dumps that happened all along the way, the robots that manipulated the prices, everything that happened in Bitcoin, the very negative press that it got, was all needed in order to get to the point where we are today, where we now have a steady, nice, upward trending, deflationary currency, technology, stock, commodity, whatever you want to call it, that it's growing on increasing user case and increasing volume. And all of that was needed. And that's why, I find it a lot of the innovation that's happening around blockchain. I'm always a proponent of, and I've invested in, a fair few of these things to see what can actually happen because it's part of the diversification. Yeah. But they need to be using Bitcoin because I believe Bitcoin has a network effect similar to the internet that will never be repeated, and there's no point recreating. And while you can create lots of innovation about all the flaws that you want to put out at Bitcoin, but what I think we've seen over time is that actually a lot of those flaws were actually features rather than bugs. And the conservative nature of the development team behind Bitcoin has actually, they've had a lot of criticism, but we still got Bitcoin that's still working. And in my opinion, nothing else is working well.
Are you referring to the block size debate or the spam attacks?
All these things, Bitcoin's had many challenges along the road to getting to where it is today. The block size is the latest one in scaling issues.
I find that debate so unfortunate. It's just, I don't know. I just find the whole, the way the debate is going to be a little bit personal attacks and just
sure.
And I would hope that these technical ideas could be debated on the merit of what they are.
And this is why I'm still kind of a fan of equity, because the block size debate shows you what happens in a DAO, because there's no governance model, so your boardrooms are there for everyone to see and everyone to participate in. And that comes at a cost. There's challenges around that, but Bitcoin has a completely good, valid reason. And because Satoshi Nakamoto is anonymous, You can't go to Satoshi and say, please, I want to influence my way. And you can with every other blockchain because it's created by people that we know, and that creates immense challenges. And I never understood the importance of that until more recently.
Yeah, the fact
and
that
also, the equity side as well. Before the DAO came out, many people were coming to us and sending messages and tweets to us. The DAO, Bank to the Future's over. We got the DAO. Why would we need anything? And I always said, equity does not really need disrupting. Equity comes with great legal protections. It comes with interoperable jurisdiction legalities. It comes with investor protections. And it's got years and years and years of lawyers behind it that have created a product that works pretty well in terms of limited liability and that type of stuff. So a DAO, while I'm all open to the innovation, I don't think equity was a bad product that needed disrupting in the first place, because you can still use technology to automate a lot of the functions of, we've done a lot of that at Bank to the Future. But the additional legal protections and contracts that come with it are very useful, and they're there for a very valid reason. But I can see one user case.
Okay.
And that is regulatory arbitrage, which is trying to circumvent regulation so that you can pull any investor into the market. Whether that's a feature, a bug, or a benefit, or a bad thing, or a good thing, will only evolve. But one thing I do know is that a lot of people investing in these blockchain ICOs and stuff like that, they're all for no regulation when it comes to investing. But as soon as they lose money, they all go running to someone should get the SEC, someone should get regulations. They shouldn't be allowed to do this. What law are we going to use in order to get them? And so they want the best of both worlds, I think.
Yeah, it's unfortunate. I personally am in favor of people having the freedom to choose. I don't particularly think that we should, just because somebody makes less than $200,000 a year, they should stay away from this class of investments. I think, they're full grown adults who are allowed to make their own decisions.
Sure.
If they want to smoke weed, I think we should, let them, I
kind of get it, but when it goes wrong, they go back the opposite. They look for law enforcement and regulations to say, why didn't you protect us? Remember, regulations only come when consumers complain. They don't proactively create regulations. They create regulations after the fact because so many investors complained.
Can Bitcoin solve that issue or no?
In many ways, I think Bitcoin has solved that issue. I think everybody that engages in Bitcoin, maybe a lot of people come along and don't understand the rules, but people know it's irreversible, so they take extra care when making those transactions. People know that they could get hacked, so they really try and figure out, how do I store my private key safely? And solutions exist for that. People know that they're not going to be able to go to their local regulator unless they can attach it to, a company or some kind of structure. So in many ways, Bitcoin has solved that problem, and people are playing by the rules. And when they lose their money, they lose their money. Whether that's a good thing or a bad thing, you can have financial institutions sit on top of it that introduce counterparty risk but solve some of those problems. But what Bitcoin is it's a no counterparty risk protocol that works, where you can transfer value anywhere in the world from A to B, but you can't change the rules unless you introduce counterparty risk and deal with an exchange or something like that.
I think there were some companies who were trying to, kind of insure each transaction, and but the amount that they would have to charge it just made the product too expensive. It was something that nobody really wanted to pay the actual cost of that, which we have in the dollar, where we have these reversible transactions or in fiat currency. But that's a cost that we as consumers bear. We just don't know that we bear it every time we use fiat.
Yeah, I mean, the merchants are assuming that cost. There's a reason why The merchants, 40% of Visa and MasterCard is all on fraud prevention, is because they need those reversibility of transactions and centralized arbitration and all those things. And that serves a role. And that's why I don't think Bitcoin eliminates fiat currency, because there's a time and a place when you want fiat currency, and there's a time and a place when you want Bitcoin. And it's when those two interact, and it's when the main thing, as kind of talked about earlier, is that if this Bitcoin experiment has firstly given the people the ability to opt out of the traditional financial system, plus it drove the central banks to create their own digital currencies, which then eliminated the problem of systemic risk in banking and introduced a new problem, which is central banks becoming retail banks and all the challenges and problems that can come with that. It's a really interesting place that we've now come to.
I've said it a few times that I don't know where things are headed. I think that anybody who says that they do is just, it's such a space that is just so tough to figure out. To really know what the future holds for things. But I do know, I don't. It's tricky to try to pull out a crystal ball and see what's going to happen. So do you envision a future maybe with, say, you could directly exchange Bitcoin for, say, stock in Facebook, and the stock would be synthetic, contained only on a blockchain, it'd be instantly, what do you call it? Not resolved, but settled. Yeah. It's where the transaction is the settlement in, say, stock purchase or,
no, for a couple of reasons. The reason, firstly, is nobody wants their Facebook stock to be a bearer asset where you have to protect your private key and it can be stolen from you. The only reason you ever want that is if you're dealing with a currency that can do stuff that other currencies can't do, such as Bitcoin. So nobody wants the ability for their stock to be hacked. They don't want they want a centralized register. The ability to change that when things go wrong. The second thing is instant settlement is not a technological problem. It's a compliance problem. The technology in order to settle instantly exists. For example, in the UK, you can do faster payment, instant settlement, banking transaction. The only challenge they had to overcome is the regulatory challenges involved with that. So it's a compliance issue, not a technological issue. So I'm not sure what additional, I can't see the user case. Example, we're on top of this sector. At Bank to the Future, we run registers of all the investors that have invested in a certain SPV that we've set up. And I've thought long and hard about what benefit could come from using that into a blockchain, and I really struggled to find one. It would be great, some kind of notarization where you could check the history of that in a way that doesn't rely upon the trust, and but there's challenges that come with all those problems, because then you introduce private keys into the equation, and then someone else's stock being able to be hacked, there's immense challenges there.
When do you think that the user experience will be better in Bitcoin? Right now you keep mentioning the private keys and keeping those secure. Will there be a time where that'll just be easy to do? Where, say, I hate to use a proverbial, my grandmother could use it, but when will my grandmother be able to use Bitcoin to purchase, stuff off Amazon?
I think the answer to that is in the hands of entrepreneurs, and entrepreneurs need to create great services, great user experiences that sit on top of this technology. And if anyone's doing that, then that's the type of thing we're looking to invest in.
I do want to talk about, I don't know if you're following legislation in the States, but I guess the Office of the Comptroller of Currency decided that they were going to issue some sort of, I don't know if you're familiar with it, some sort of where all the different, right now each state sets their own policy, and I guess the Office of Comptroller wants to say no, it's going to be the entire country and not each state won't be able to determine their own laws regarding cryptocurrency. Do you know anything about that or no?
I don't know. I don't know too much about it, and I'm not. Yeah, I mean, America has real challenges in the segregation of state law versus federal law, and that's one of them. A lot of companies, they're in America just simply because of the funding, the venture capital, the markets, but that's a very good reason why not to be doing this type of innovation in America. And that's why a lot of jurisdictions like Singapore, many other jurisdictions that are looking to compete in this market might win some of the market share, and the investment markets are going way more global. I think we're reaching that point where there's less importance in Silicon Valley and geography than there has been in the past. It's still important, but this global thinking of picking the jurisdiction that's most suitable for the legislation of the fintech that you want to create, and knowing that there's global solutions for still raising finance. We can't quite reach the point where we can close a funding round the size of a huge venture capitalist yet. But if we continue on the growth path, then there'll be global finance at the same time as picking the best jurisdiction, and that breaks again the geographical dependence that startups have had in where they're located.
So you think New York's time as the financial, would you say New York is the financial capital of the world right now?
That's a very interesting question. Wall Street is still very important. Wall Street has the US dollar. The US dollar has gold and oil priced in US dollars, and therefore the United States can do things that other countries can't do. And it also has the international agreements through its foreign policy, whereby it has military bases in many countries around the world, and people are saying we'll join the American philosophy. You take care of the defense in these bigger issues, and that's kind of like the unwritten agreements of the world right now. And so America has a very unique position in the world, but if you look throughout history, the end of almost every empire is normally inflationary and financial and currency related. So, US dollar is still, I love Bitcoin, but US dollar is definitely, the most useful currency in the world still. What kind of catalyst, what kind of events, are gonna materialize to change that? I'm not sure, but we're definitely at the start of some kind of trend and some kind of decline. Maybe that's just a movement towards the next generation of people all being brought up with global thinking, where jurisdiction is less important to them in the way they manage their affairs.
You think Singapore or Toronto or is it San Pablo in Brazil? Is that a big one?
No, I mean, all of these countries are all looking to, why are so many countries coming out speaking about supporting blockchain? It's because they've all got a fear in them that they want to stimulate the next industry in their economy. They want to create the next wave of jobs. And if banking is going to be disrupted, they're making a slight bet that they could end up creating a load of jobs and economic growth for their country by supporting that sector. Those opportunities are only going to go to the jurisdictions that have the most to gain and the least to lose. So, jurisdictions like Jersey, they're a banking, jurisdiction. The jurisdictions like Singapore, while they've got a lot of banking relationships there, they can also afford to take more risks with their regulatory structures and try and become a hub for blockchain and Bitcoin and Isle of Man and all these other jurisdictions. So, it's a government level decision. But here's the important thing that I've learned. It's great to have competing jurisdictions so that fintech startups can go to the jurisdiction that's most suitable to allow them to do the innovation that they're looking to bring to the world. But almost all of them are looking to do global solutions. And on the ground. Some of them are on the ground things, but people are thinking less and less in these ways.
Yeah, definitely. A lot of these places will be able to leapfrog. They won't have to, they have no banking right now, but large impact of Bitcoin is going to, reach these places where they can skip over, private banking in that fashion and go directly to much more. How do you describe it versus,
It's different. It's but Bitcoin allows you to own your own money, to spend your own money, and it's based upon a monetary policy that should encourage savings and increase your purchasing power over time. It also allows you to intersect with the global markets as entrepreneurs create more solutions that you may not have been able to do before. So what needs to happen to make people think of the importance of those things? A couple of things. Firstly, eliminating cash by the government in order to control everything. They're going to start looking at how they can have the same features of cash in an environment where their cash might not be able to be spent, just like it's in India. Also, if you lose your deposits, just like we're seeing next in Italy, like we saw in Greece, like we saw in Cyprus, like people are going to be experiencing decrease in purchasing power in the pound after Brexit. And, what happens when Trump uncertainty rolls through and when walls are built between Mexico and, all of these forces. And then China introduces new capital controls to try and keep the currency in the market, and Japan continues to deflate the currency in order to import, to push their expenditures, because all these countries are competing jurisdictions with competing goals. They drive the next wave of adoption for Bitcoin, which is the neutral money that doesn't care about jurisdiction.
What about you, Ethan? You got any questions for Simon?
What do you recommend for the poor folk who are just starting out and aspire to?
Yeah, for the millennials that have been fucked over by the system.
Yeah, well, unfortunately, for regulatory reasons, this kind of asset class isn't the type of asset class that those who don't have wealth can take advantage of. But Bitcoin is, and if the way to generate wealth is pretty simple. It doesn't really matter what you start with. It doesn't really matter what your income is. But if you can take a percentage of whatever you earn and you can invest it, and I wouldn't necessarily recommend investing in through Bank to the Future at this kind of level, because it's too risky for that. But you take a percentage of your income and split it into 3 buckets. Let's say you take 30% of your income, no matter what you're earning, if you can afford after paying your mortgage or your rent, or you just figure out how to do it, and you mechanically put 30% aside. 10% of that can just go into benefiting from a very, what has traditionally been a riskless product, whether that be, a mutual fund or stocks or bonds, that will perform if the traditional financial sector continues as is. Another percentage of that you could put in something very speculative and very risky like Bitcoin, where there's the opportunity to actually create hyper growth over time. But you're also aware that you could lose that money. So you've gone into it knowing that, hey, I could lose this at any time, and you've kind of written it off. And then, you kind of, and then you just continue doing that and benefit from compounded interest. And no matter what your income is right now, over time, that increases. What the challenge that most people have is they never start thinking about investing. They never start thinking about saving. And they say to them, well, I need to get a new job, or I need to pay off this mortgage, or I need to do this, or I need to do that, before they start actually saving, no matter how small it is. And that's the crisis that I believe a lot of people in, because the way the property markets are going right now, they just can't get on the ladder. They're continually paying rent, and their disposable income and wages go down. So you just got to decide that this is I'm going to invest a percentage of my income. I'm willing to lose it in the very speculative stuff, and the non-speculative stuff I'm going to benefit from either traditional finance continuing, and the other half the alternative, which I believe will, if everything goes the way we believe it will go, and there's risk involved in whether it will outperform the traditional.
Yeah, thank you. This has been a really good podcast, gentlemen. I've really enjoyed listening.
Yeah,
Well, thanks for having me. Okay, well, I hope I didn't use too much jargon. I try and keep it to terms that most people understand. But with technology and finance, it's a recipe for disaster in terms of spitting out jargon.
Technology is the worst, but finance is pretty darn close.
Yeah.
We got them both on this episode. I was able to follow. It was enjoyable.
Good.
Perfect.
Okay, thanks, guys. Are you going to be interviewing Kush?
We'll do a good interview with Kush. I want to hear about tally sticks and what's it. Do you want to talk about? You want to pitch any of the other, like Bitfinex is doing a crowdfunding, right? Or not a crowdfund, but a funding with Bank of the Future and tally sticks, and then there's one other. You have 4 live right now, or no?
I think we've got Airbits, tally sticks, and Bitfinex.
Okay. Did we? Yeah. There was a brief moment in the conversation where where you're talking about exchanges being. Maybe we can edit this into the episode a little bit if we wanted to. You were talking about exchanges being really important, and I wanted to mention, but I got distracted. I wanted to mention, yeah, and you have Bitfinex as an option, and if you know what's going on with Bitfinex, they had a hack, and they kind of gave a haircut. They took people's deposits and said, if you had 100 Bitcoin, you actually only had 42 Bitcoin, and gave you the what would that be, 60, no, 50, 58 Bitcoin.
It was a 36% haircut.
There you go, 36% haircut. And so then they're paying that back at the quicker pace than what they initially thought they would do. But is that why Bitfinex is having such a hard time, or not having such a hard time, but hasn't reached their goal yet? Or is it a new funding, or has that caused issues, or?
No, so the Bitfinex deal is a very unique deal that we put together as a specific recovery plan, because we've been through the Mt. Gox saga, and we knew how destructive that was to Bitcoin, and also we're still feeling the effects of that today. And all of the investors lost or anyone that had money with Mt. Gox has lost it all. I believe the lawyers, the auditors, and the accountants have done very well. But no one else has. So when Bitfinex got hacked, and it started to have an impact on the price of Bitcoin, we started to, and they started to implement a recovery plan. We wanted to get our legal counsel to discuss with their legal counsel how we could support a faster recovery, and actually see if we could support in any way, make investors whole again. So I believe that what Bitfinex did, for all the criticism that everyone will give them, and they have received, they, 1 week after having $72 million stolen from their customers, were trading again rather than going bankrupt. They issued a token called BFX token, and they created a new user case for the blockchain that we haven't seen before, which is they created a token that represented the amount of money that was stolen by the hacker. And they decided, rather than, Bitfinex is a bit unique because they do a lot of, they've got a peer-to-peer lending market where people can lend their US dollars in order to help speculators that want to go long or short on Bitcoin. And so they had a large US dollar balances as well as Bitcoin. So although it was only Bitcoin that got hacked, they had the option to socialize the loss. And so they gave everybody a 36% loss, but everyone could withdraw when they got back up in a week or so. But they created a token that represented the 36% loss, and it traded on a market. And so those that were, completely not forecasting anything good for the Bitfinex hack recovery, could just sell their token, and immediately it was issued at $1, and the price went down to about 30 cents on the dollar. So for those who had debt that Bitfinex owed them from this hack, they could sell their debt at 30 cents on the dollar and be done with it, and then they only lost, and I'm not saying only because I don't want to trivialize it, but they lost, about, let's say, 30% of their deposit, even less, about 25% of their deposit.
Which is pretty good for an exchange that might have gone bankrupt otherwise, or I don't know if bankrupt's the right term.
Well, correct, because it would have been bankrupt, certainly. It was over. They didn't have 72 million on reserve to plug the gap. So they decided to take this approach. Those that wanted to speculate on them could buy those tokens at 30 cents on the dollar, and Bitfinex, if they continue to grow, they will be repaying those tokens at $1. Locking in, for a speculator, they could lock in a 70-cent profit if they got repaid, with the risk associated with whether they get repaid or not. But what we did at Bank to the Future is we set up a special pitch just for victims of the hack that had BFX tokens, that were, if they were accredited investors, then they could convert their BFX tokens for equity in the company. And if you wanted to invest in Bitfinex, rather than taking their valuation, you could actually buy BFX tokens. And at this point, they went from 30 cents on the dollar to 60 cents on the dollar. And you could get a 40% discount off equity in Bitfinex. And of the 72 million tokens that were issued, we had approximately 30 million of them, I think that come close to 31 now, that converted them for equity in the company, which then took the debt down from 72 million to 31 million. And then Bitfinex started actually repaying some of the token holders bit by bit. So they chipped away at about 3.5 million. So they're now, the maximum that they wanted to do was up to 72 million, which represented 100% conversion, which was never going to happen. It was just the option. And now they're trading again. Their volume's going up, and they've still got a lot of the liquidity. And a lot of their customers have now become their shareholders. And there was an opportunity for speculators to, make some of the money out of it, and for those that were more risk adverse to only take a smaller haircut. And in the end, I think they created a model that will go down in economic textbooks in history as a disruptive model to liquidation proceedings.
Has there been anything like that in history, or no? Is that brand new, like thanks to
Absolutely
the blockchain?
not. That was 100% fintech innovation that led to and this could all still go wrong if Bitfinex goes bust. Then it will go down as a disaster as well.
And then you try it again with changing a few inputs and trying to make it better. I mean, there's going to be a way for companies to not when something goes wrong, to not have the lawyers get all the money, to have the company try to stay afloat in some other way to, socialize the loss, I guess, if you want to call it that, to do something other than, okay, well, it's going to go bankrupt, so let's give it all to the lawyers and the judges or whoever else is involved,
Yeah. So purely as an investment, some people, bought BFX tokens at 30 cents on the dollar, kept half of them, which are being gradually redeemed, and they may be redeemed at $1, locking in a 70% profit over time. They also took half of them and converted them to equity, which once the debt has been repaid, if Bitfinex, which was prior to this a nicely profitable company, they intend to distribute their profits through dividends. And this, for some people that took the risk on board, could end up to be one of their best trades. And a lot of the customers that didn't want to take the risk, I mean, it sucks, they lost some money, but they still probably kept about 80% of that in sometimes the worst case scenarios.
Cool. I think I could probably ask you questions all day, but we do have to wrap it up. So
Yeah.
I could listen forever. This is a good episode.
all righty, Simon. Well, we're gonna let you go then. But thanks so much. We'll interview Push on Monday, and I'll try to get this episode out on Monday as well too. But I think if I'm thinking things right, it might be delayed a bit, but we'll see.
Okay, no problem. All right, nice to meet you guys. Keep up the good work.
Yep.
Cheers.
Thanks. Cheers.
Bye-bye, and good luck with the new one.
Thank you.
Bye-bye.